this thing going.
How's everybody doing? We should do a round of introductions of everybody that's here with us inside the room. We'll start off with myself. My name is EJ, lifelong San Francisco resident. Not an official SF Black Wallstreet member, but proud to be here today, and proud to have the opportunity to co-host with these lovely young ladies today. So I'm gonna pass it off to Miss Gwen Brown for a quick introduction as well.
Can you see me? Hey guys, I'm Gwendolyn Brown from San Francisco Black Wallstreet, also San Francisco native. Just want to welcome everybody joining us today. This is the first of the series, and we're very excited to get this started. So, passing it on. I'm Tiffany, Neighborhood Tiff. Y'all know me. I'm a founder of SF Black Wallstreet, and very excited to be joining you guys. I'm learning with y'all, so let's all take notes and let's get it.
Hey y'all, my name is Tanish Hollins. I'm one of the co-founders of SF Black Wallstreet, native of Bayview Hunters Point, San Francisco. So honored to be doing this with you all in partnership with African American Cultural District in San Francisco. How important this work is that we're doing to build wealth throughout San Francisco and the Black community specifically. We are so honored that you're here with us. Thank you. And Mark, we've been really looking forward to it.
Yeah, we super juiced. Like,
we're trying to get some money.
We're trying to get the bag. We're going to talk Tesla, Apple, all the stuff. So y'all be listening to me and I get it all from him. So.
All right, so we're going to kick this off. I think the best way to probably start this off right now is from Mark, to just give us a quick little introduction and background on how you got started with investing, and why do you think it's important for Black people to know this information?
So I guess we have to roll the clock back, Lord, years, back to the point where a 9-year-old boy living with his grandparents wanted to sneak downstairs on Saturday mornings to get donuts when his grandfather would have investment club meetings. And then that young boy just happened to do, let's just say the mistake that he made ultimately changed the course of his life forever. I got caught because I would hang out in the bathroom that was like this thin wall between that and the den office of our downstairs area. And I accidentally put a hole in the wall because I fell asleep and I knocked the ironing board and it just put a hole through the drywall. And so that's when everybody found out that, hey, there was some commotion behind the wall, and that's when I got caught. I was there for a donut, and then ultimately that changed my life because pretty much after getting in trouble, of course, for putting a hole in the wall, anybody that has Black parents, you understand what we all family here, you understand what that's like. But then after that literally changed my life. It literally changed my life in the sense that, I was introduced to a room where I was sitting there amongst other Black men that were trying to build wealth and amass it for their families, to understand the knowledge. And they happened to be taught by a gentleman that worked on Wall Street. And of course, at 9 years old, you don't really understand it, but the way that he was able to explain it, and then on top of that, my grandfather explaining it to me, it started to change my entire perspective. So from there, fast forward to probably later on that year, probably like when I turned 10 years old, I had amassed enough knowledge where it was time for me to test that knowledge. And the way that my grandfather raised me was, in order for you to be able to own a stock, you had to pitch, why you were going to invest in a stock. And then on top of that, you later had to defend it. And so I pitched it to my grandfather. The first go around, it was a no-go. Couldn't defend my reasonings for why is it I wanted to invest in things. And then me being competitive, that just made me want to come back even harder. So pretty much second go around, I did it successfully. And that first company that I invested into was Starbucks. And so I got my first ever Starbucks stock, and I was super pumped. understand like what that trajectory that was placing me on, but I just knew that it was putting me in a place where, honestly, it was leading somewhere. I just didn't know where it was taking me. Fast forward to 2004, my freshman year in college, I went to Tuskegee University, where I got my first refund check, and I just said, I want to make some money. I did my first ever trade there, and went from $1,500 in a refund check to $4,500 in return, because I started exploring the world of options outside of stock, and got super duper pumped, but then also got cocky. And after getting cocky, just said, okay, hey, I could just let this sit there and cook, forgetting about the expiration and everything else. Came back a few days later. I went from up $4,500 to down 99%, lost my entire investment. And I was hurt, because for anybody that's in college, when you get that refund check is life. That's like your lifeblood. And so pretty much what I did was, of course, after crying and after many peanut butter and jelly sandwiches later, I came back and I said, you know what, let me just go all in, because obviously I'm onto something right. I got to trust the fundamentals, but I just got to be more diligent, and I got to be more disciplined. So then after that, started going from making simple investments. Those simple trades started turning into decent profits, and I kept doing it, and I got good at it. And of course, it was never really anything perfect, but the more that you keep studying, the more you keep practicing, you get better. And that's ultimately what happened. By the time when I got to my junior year, I was able to pay off all of my student loan debt. I also was able to, also in the process, Alabama, Tuskegee, Alabama houses are cheap there. So, I was able to also pay for a home. Instead of living in the dorm and paying $12,000 a year, I just said, hey, why don't I just put that towards real estate? And so I did. And so I got a home, paid off my student loan debt, and then from there, kept trading. That trading helped me start funding my startup, which I came down to San Francisco to try to get like an angel investor and VC funding at the time. And that was just like a crapshoot. Ended up getting one investor though. I don't know if anybody knows who that is. Mitch and Frida Kapor at Kapor Capital. They invested in our startup. They were the only investors. I want to say 11 months later, we received an acquisition offer from Monster.com. It was an app focused on helping recruitment by validation of skills, and sold that company, got into venture capital because I wanted to start investing into startups that had significant social impacts, because that really means a lot to me. Then after that, I started noticing that, hey, I'm definitely I'm definitely nowhere where I used to be, of course, by any shape, form, or fashion. But then I started realizing exactly how lonely it was once you make it up to the top of the mountain. When you start looking around and where the faces that you used to see, come rare, far in between. When you start realizing that, you're sitting pretty much in a group of white men, middle-aged white men, and honestly, they can't relate to anything in which that you've gone through, or the fact that they don't understand what to struggle. Many of them never understood what it meant to struggle. And so I just said, something's got to change. And I think that where I started with, mentoring any individual that wanted to listen and wanted to learn what I knew on the investment side, I started teaching. And what made me start doing that was, I remember being at Target one day, and just as something simple as a Black family just doing their shopping, and their daughter wanted them to buy her some coloring books. And it broke my heart that they couldn't afford it. Like something like that, like I realized something like that is super duper powerful, where just the smallest thing of just buying a coloring book could maybe spark that child one day becoming a dope UI UX designer, or designing the next best fashion line, Or say, for example, coming up with, like, if you look at Steve Jobs, he created Apple because of his love for serifs, or pretty much fonts, and wanted to create beautiful fonts on a screen. So it broke my heart. And so at that point, I said, okay, hey, I can do something here. And thus, I started mentoring. I started teaching folks what is it that I knew, trying to give them the tools. And then my pretty much my partner in crime, Jolene from the Come Up series, would happen to be one of the people that I was mentoring. She randomly one day put up on her Facebook that she had made 918% return in 1 year. And of course, that kind of just sent shockwaves. And so then my inbox is being flooded and everything else. And then that's when pretty much the birthplace of the Come Up happened. I was sitting at the Tesla supercharging station, and we were explaining, and then we were just like, yo, there's so much more that what we can do to help people who look like us get out of this, pretty much to get out of the hole and to start building something for their families, their kids, their next generation. And we have an opportunity to be a part of that. And me realizing the sacrifices and what it would take in order for me to get there. But by that point in time, it just didn't matter. And so here I am today.
Well, thank you so much. That's so deep.
So since we're talking about the beginning of the investment journey and kind of how folks get started, what tools do you think people need to initially get started in investing?
Oh man, it's so much easier today. It's so much easier because there's so many tools that are at your disposal. Like, for example, you have the CNBC app, which you can really start. A lot of times, the simplest way to start is start looking at companies that really have an impact in your life. I always tell people, look around your room and then see the companies that sit around you. The companies in which that you buy, whether you're driving, look at that's a company. And then start reading up on what's happening at the company. And then there's other tools like, for example, Yahoo Finance. These are all tools in which that are free, of course. CNBC, Yahoo Finance, Bar Chart, where they the more that you Bar Chart is one of those companies where you just want to know the ins and outs of a company. You look there. When you want to know about how the news is impacting the company's value, you go to a place like CNBC. So there's tons of tools. There's tons of books like Money Master the Game by Tony Robbins. There's Intelligent Investor by Benjamin Graham. There's Get Rich Carefully by Jim Cramer. So many tools. So many tools. And then on top of that, I always say, make the companies human. Just like how we look at athletes, or how we look at reality stars, how we know pretty much the ins and outs of their business, pretty much their business. We'd be so nosy where we know everything about LeBron James. We know when he sneezes, because of the fact that we realize that these things are human and they're relatable. You can make the companies and the things in which that surround you relatable, and it just becomes so much easier.
So what would you say, just for a person that's just getting into the game, what apps are, a lot of us are using Robinhood, and I know you don't like Robinhood, but tell us why not, which ones do you suggest, and how does the average investor, the newcomer, get into investing in stocks?
Well, I would say this, it's each and every single one of you're already investors. That's one of the first things that I tell everybody. You're already invested, because the things in where you spend your money, that's where you invest. So for example, if you go and spend a lot of money at Target, or at, say, for example, Nordstrom, Macy's, or wherever it may be, you're already investing in that company. The only problem is you're investing in it as a consumer versus as a person who wants to make money from the company. The reason why I don't like Robinhood, oh man, the list is so long. But the reason why I don't like Robinhood is because of the fact that they do cheat a lot of folks when it comes to pricing, since they don't give you the most real-time pricing, which means that you're seeing a lot of delayed pricing. So which means that you're still going to be stuck holding the bag, paying the price premium, versus if you were at a brokerage like, let's say, an E-Trade or a TD Ameritrade, where I understand that those are a little bit more sophisticated, but at the same token, they're sophisticated for a reason. So like, for example, if you're an options trader, I'll give you an example, or just a regular stock investor. So if you're looking to buy the stock on Robinhood, and let's take a company like Apple, let's just say in a perfect world, Apple is valued at $100 a share. So at E-Trade, I'd probably see it probably executable at $100 and let's say at 1 cent. But for the Robinhood investor, they would probably be seeing it with such a delay. And since there's so much activity happening, you'd probably be seeing it at $100.25 all the way up to $100.45 a share. So you're getting it at a delayed price, and at the same token, they're not telling you that. And then it's like they're not going to give that money over to the market maker. They're going to give a portion of that to the market maker because of the pricing, but yet at the same token, they're going to pocket the rest. And then on top of that, the fact that they just throw so much margin, like for example, they give some folks 200% worth of margin, whereas margin, which is pretty much like credit, it's not, it is credit. So let's say if you put in $1,000 into your Robinhood account, they can give you all the way up to an extra $2,000 worth of margin, which means that if you trade on that, now you're going to have to cover, say for example, the 2,000, and at any point in time they can make the margin call, and then they'll either pull you out of the position, or if you're down, it's like you just start to, it's a way of digging yourself into a hole with a brokerage account, versus typical brokerages, they give you about maybe 100%. So if you invest 1,000, they give you another 1,000, and there you are, you're at 2,000 versus being at 3,000. So I don't know if many of you guys heard about the young man where he committed suicide because he lost almost $1 million worth of margin, and there was no way that he was able to cover that. It's just those types of things in which that I'm saying that they have some predatory practices. I'm glad that the SEC is doing its investigation on Robinhood right now and doing its probe. But there's tons of other brokerages. There's even a Black-owned brokerage called Doe. Super duper awesome company because of the fact that not only do they give you the tools of a brokerage, and at the same token, they also teach you about the company before you even make the investment. So they give you the fundamental knowledge that you need to learn about the company. And it helps you understand why is it important to invest in this company, or, why is it not important?
So Mark, I'm going to ask you a question, because we have a lot of people that are tuning in for the first time. This is their intro. So we know a lot of resources for folks to learn more about the language you're using. But can you explain a little bit about what a brokerage does for the folks who may not know?
What are fundamentals?
Mm-hmm.
So fundamentals are pretty much, I like to call them the ABCs of a company. So when we look at the ABCs, like for example, if I was to ask you, like, when we look at the stat lines of, say, for example, athletes, we judge them based upon, like, say, for example, points, rebounds, assists, steals, blocks, all those types of stat categories. Well, companies are judged by those same type of stats, except, not by points. They're judged by revenue, profits, loss, PE ratio, which is price to earnings. They're judged based upon their balance sheet, how much credit, how much cash, all those types of things in which that make a company successful or not successful. And you're able to see those things in pretty much black and white, just like you're able to look at any other stat line. And like I always say, fundamentals don't lie, just like charts, they don't lie. So that's one area where it's like every company, think of the company like a kid, where a company every year or every 3 months, they're going to give you a report card. Just like when you were in school, you had a report card at the end of every quarter. And that report card tells you exactly how well or how bad did the company do. Now, of course, for anybody that remembers being a kid, sometimes it's like you would tell your parents, oh yeah, everything is great, everything is going well. And then the report card came out and then that just told a totally different story. And that's really how you look at it from a fundamental standpoint. The questions that we really care about is, one, how much revenue did the company bring in? Okay. Then outside of that, how much did the company lose? Or were they significantly profitable? We also look at the fact of, say, for example, oh man, there's so many, and I'm going to start geeking out pretty soon. But there's so many things that we look at, like, for example, how much cash do they have on? The reason why we ask about how much cash, think about it like this. Everybody has that one friend where it's like, you know, when you're ready to go out somewhere and they don't have cash on them. And it's like, they're that person that says, okay, hey, can I hold this? Can I hold $20? I mean, think about the same thing when you look at it like a company. Like, when that company doesn't have cash, and that means that they need to borrow. So would you rather go with a company that has more cash on hand, or would you rather go with a company that doesn't have as much cash on hand? The reason why cash on hand matters is, let's say, for example, COVID-19 happens. When that company doesn't have any cash and they're strapped for cash, what happens? Now they're stuck. Now they're having to either go borrow, or they're going to have to leverage their company. So which means that ultimately you're not getting the type of value as an investor that you should be getting, versus, say, for example, a company that has, let's say, $200 billion sitting in cash on the sideline. A company that has $200 billion in cash sitting on the sideline versus a company that has, say, for example, $10 million in debt. Those are two totally different things. And that's why we say the fundamentals matter, because those are the types of things that make fundamentals.
Awesome. And I think the second part of her question, I think we might have froze, so it may not have come through clearly, was what is a brokerage for folks that don't know, since we're starting kind of at the big
Cool. So a brokerage is pretty much a place where people like you and I, we put our money in so that way we can invest in companies on the publicly traded market. That's the definition of a brokerage. Now, there's many different types of brokerages, right? So there's Robinhood, there's E-Trade, there's Doe, there's TD Ameritrade, there's Fidelity, Morgan Stanley, and so on and so on and so on and so on, Charles Schwab. These are all brokerages in which that you will set up a brokerage account, and from that brokerage account you put money in, and then from that money you're able to invest in a company.
Perfect. We have a question from the comments or the chat. Have you heard of Webull, and what do you think about it?
Wait, say that again. Oh, have you heard of Webull? Yes, I've heard of Webull.
And what do you think of it?
I mean, if it works for you, it works for you. I mean, like, honestly, if the platform is working for you, and honestly, it's like, if, you know, I'm not gonna be the type of person where it's like I'm gonna be like the platform police, where it's just like, okay, well, this platform is crap. The reason why I talk so negatively about Robinhood is because of the fact of the predatory practices in which that they do. Webull is pretty much another brokerage platform where it's very accessible, very easy to use, and if it works, I mean, it works.
And I think we have a lot of kind of similar questions. Someone asked about Cash App.
By that time, you should just be using a real brokerage account.
A good question from the chat is, due to the economy and pandemic, everything is 50% off. Do you have any recommendations on where folks should be looking right now?
Well, if you go to either my Instagram at IAmMarkMonroe or at that Come Up series on Instagram, we actually lay it out where we give you 20 companies in which that you can actually buy or trade.
Okay, so a lot of people, you know, some people invest in the short term and some people invest for the long term. How long should you really be holding on to stocks?
It depends upon what your strategy is. You know, if you're looking to build wealth, I mean, I start with this. Every person that I literally sit down and talk to, and I guess since I'm talking to each and every single one of you, I'll ask you the same question. And if you want to, you can just throw it up in the chat if you'd like. Would you rather be rich or would you rather be wealthy?
We want to be wealthy.
Well, but the thing is, it's like when I ask that question, it's like a lot of folks, they understand like the concept, but it's like,
well, what is that?
What's the difference?
Like 5 years? I hear a lot of people throw 5 years out that you should
wait until you sell? Or
Well, let's look at it like this. If you had invested in Netflix around the time when it first went IPO, then you'd be sitting, you invested, let's say $1,000, you'd be sitting at, what is it, $150,000, $200,000. And I think that's over, what was it? That's not 5 years, that's 10 years.
So patience makes paper. That's what we hear.
I mean, long term will always outperform short term, because I always say this: when you think of short term investing, I always put it like even a broken clock works twice a day. So, which means that you may be right every now and then on a short term trade, but then just think about all the times that you're wrong in the short term, and think about how much money you lose. And then on top of that, when you do that, think about almost how much money you give away to Uncle Sam every single time you hit sale from when you are right. Especially most folks are trading or investing out of a brokerage account, which means that you pay the capital gains tax as well. So for every time that you hit the sell button, you're also realizing that there's going to be that capital gains tax that you're also going to be hit with.
I heard you say something about an IRA or something like that to avoid capital gains.
I did. So on the come up series, I definitely talk about investing out of IRAs, because one, you can protect yourself in the form of your tax contribution. So it actually works for you, where you can contribute up to, I think it's $6,000 a year. The cool thing about that is you can trade out of your IRAs. And then on top of that, when you decide to sell, there is no capital gains tax. There is no income tax that you have to report for the year. The only time when you have to report it, when it's time to withdraw from your IRA going into your checking account. And then that's based upon if you have state income tax and also federal income tax. And it's not the same income tax as though like your jobs, or like, for example, your basic income. It's the passive income tax. So a lot of folks look at that and they're like, wait a minute, what's the difference? There's a huge difference. So when you're looking at your basic income tax, that's pretty much your tax rate of what you're going to be paying. Say, for example, depending on where your tax bracket, you're paying based upon your tax bracket. Oh, hello.
Sorry, we got a little feedback. There we go.
Okay. All right. So you also, but when you do passive income tax, it's way smaller. So you're talking about anywhere from, I think it's like 10, 20%.
Awesome. Can you explain what day trading is? We hear that term thrown around a lot. And how do people actually profit off of day trading?
So day trading is pretty much where you're sitting down at your machine every day, literally, and you're pretty much that's your day job, where you're dedicating a significant amount of time into either buying stocks or trading futures or options, and you're pretty much, that's your everyday thing. In order to be a day trader, I mean, you're going to get hit if you're doing 3 trades I think it's 3 consecutive trades within a certain amount of days. So you get tagged as a pattern day trader. And then in order for you to keep day trading, you have to have at least $25,000 in your account. If not, then your brokerage will freeze you or throttle you back.
So for the average investor, how often do you recommend taking some of the profit away? Should you just is your recommendation to leave the money and let it sit and grow, or do you cash out sometimes, and when do you typically do that?
So for me, it's like, I look at, and that's where it comes back to your strategy. You have to look at it and of, what is your goals? You have to set your goals of what is it that you want to achieve. And so if you're looking to make money faster, then you're going to have to get a little bit more strategic in figuring out like what that strategy looks like. I always say I define strategies in the form of 3 things. Think about it like microwave, oven, slow cooker. Now, for anybody who cooks on this chat, ask yourself this: which is better? Would you rather have a microwave meal, a stovetop meal, or a slow cook meal? I think 99.9% of folks would say they would rather have a slow cooked meal because it tastes better. And so when you think about your investments in the same way, it's slow cooked. But when you look at it over a trajectory of time, you start thinking about your money like it's an employee. Now you're an employee probably somewhere, or you're a small business owner somewhere, and you're making money so that way you can earn a living. The excess money that you have, you're going to put that into the market, and when you're putting that money into the market, you're saying, I want my money to start working for me. Now, it depends upon how hard you want the money to start working for you. And then on top of that's where it's going to come down to your strategy. Now, of course, the more aggressive that you want the money to come back, it comes with risk. All investments come with risk. But the more that you say, for example, say, hey, I want this to come back a lot more aggressive, then so too does the risk rise. If you don't want the aggressiveness, if you wanted to say, okay, hey, be steady Eddie for me, then the risk comes a little bit off the table. And so then at that point, now you're looking at it in the form of trajectory of time. For everybody on here, I'm 20% stock ownership, and then the rest I'm an options trader. I trade options on the long term, and a lot of folks think that you can only trade options on the weekly. I don't do that. I trade my options on a 1 and 2 year span. The reason why? I like my options to be slow cooked. But at the same token that they're slow cooked, I mean, at the same token, that allows me the opportunity to be able to grow my capital or my investments on a yearly basis at around, on average, 7,500% return year over year. So
that's a really good question. I'm gonna follow that up with a good question that we got from the chat, but I might need you to step back a little bit and explain what options are to folks.
Because I don't understand options. I'm like, oh my God, options give me a headache.
And then I have like a good follow-up that came from the chat in regards to options. So we're gonna break this down for folks.
Let's do it brick by brick in the form of what my friend would say. So options. How many of you understand real estate here? Like just for those that I can see, just nod your head yes if you understand how the real estate game works. Okay. So let's put options in your world of like what we know of real estate. So say, for example, you wanted to go ahead and buy a home, right? You wanted to buy a home for, let's say, in today's market, we'll just say hypothetically $400,000. You wanted to buy a home for $400,000. The problem is you don't have $400,000 worth of capital.
Not in San Francisco.
Like I said, San Francisco and Seattle are a lot the same. So I totally feel y'all.
But for the sake of the conversation, we're gonna rock with it.
We're gonna rock with it. Hold on, let me let my dog out real quick.
Guys, if y'all have questions towards the end, start raising your hands and y'all can ask him directly.
So say, for example, you have that $400,000, you'll do what is called a lease option to own. And on that lease option to own, you will be in that lease option for 2 years. And you sign that contract with the owner saying, hey, I'm willing to buy this house for $400,000. Now, the money that you pay towards rent, a vast portion of that will go towards the down payment of your home, right? Simple. So then the 2 year period comes and the value of the home has gone from 400,000 to, I'll add some San Francisco pricing there. Let's say it's gone from 400,000 to $700,000.
There you go.
Now ask yourself this: what price are you on the hook for? Is it the 400,000 or is it the 700,000?
Before, right? 400.
It's the 400,000. So which means you walked into that house with a $300,000 profit.
Right.
Now, the reason why you did that was because of the fact that it was cheaper, but the only risk that you have is the money that you put in. You pretty much, if you walk away from the deal, then that's the only money that you lose.
Mm-hmm.
Now let's flip it, right? Let's flip the script and bring it over into my world of options.
Mm-hmm.
So let's say that home is a company. And let's say instead of $400,000, we're going to say that the price of the home, instead of saying the price of the home, we're going to call that what is called the strike price. So I'm going to set my strike price, let's say for Apple, I'm going to set my strike price for $200 in 2 years. So by the end of 2 years, I'm willing to pay $200 or possibly sell it over to someone else. Remember, option, you have the right to buy or sell this option to someone else. Okay, he's playing with a Spider-Man toy. All right, so then So we have the $200 strike price. We have we know that the term is for 2 years, so it expires in 2 years. Now, if the value of the home or if the value of Apple is rising, then so too will my value of my option. It gains in value. So I guess we'll make it even more simpler. For everybody that has pen and paper, which I hope that you have pen and paper. All right, there it is. So let's draw a line down the center so that way I can show you what the world looks like in the real world. So let's say that let's say that in a perfect world, you have $10,000 to invest. You have $10,000 to invest and the company is Apple. Now you're saying that over a 2-year span, you're saying that the value of Apple stock will reach $200 a share. Now, the value of Apple stock today is at $100 a share, right? So now what we're going to do is on one side, we're going to write stock, and on the other side, we're going to write option. So both sides have both sides will have $10,000, and I'm going to show you how the money is different. Is everybody ready?
You want to show them how your paper is set up?
We have
I can't see you. You're going to have to really get
stock on one side, option on the other.
Stock on one side, option on the other. Both sides have $10,000. So
I'm seeing some thumbs up. I think we're ready to go.
Okay. So then let's say on the stock side, you say that Apple stock right now is currently worth $100 a share. So then you divide the 10,000 by the 100. How many shares do you have? I know that we all have phones, so go ahead and pull out your calculators. It's okay.
100.
There you go. You have 100 shares of Apple. Now on the option side, you take that same 10,000 and you say that, okay, hey, my strike price is for in 2 years from today, so September in 2022. I say that Apple will be worth $200 a share. So that's my strike price, $200 a share. Now we're paying today is $1 per contract. So options are warranted by contracts. So there's one contract that's worth $1. Now every contract has 100 shares in it. I'm showing you the math of how the formula is constructed at the same time. So you have one contract times 100 shares. So whatever the contract price is times 100 shares, that's the actual value of the contract that you're paying. So let's just say that the value of the contract is $1. We multiply that dollar times 100 shares, it's $100 per contract. Take that same 10,000, divide that 10,000 by that 100. How many contracts do you have? Spoiler alert, it's the same thing.
The same, right?
It's the same thing.
It's the same number.
It's the same thing. I guarantee you, from here on out, this is where the money becomes different. So then let's take that 10, let's take that on the stock side first. Let's say that Apple goes up $25 a share in 6 months. So it goes up by 25%. So $25 times 100, what is your profit?
2,500.
Well done. Now let's say that on this, so we know that the stock went up by $25, but instead of it being now worth $1 per contract, that contract is now worth $4 a contract. So now let's do the math. 4 times 100 times 100.
40,000.
40,000. We need to learn options.
We need to learn math. Look, your water. We need to learn math and options. Wait, so that's a cold flip, Mark. That's a cold flip. So it's because this is options.
No.
So it's the contract price.
Sip y'all water, y'all. Sip your
Right.
water.
Water.
I gotta stay hydrated in this game, y'all.
Definitely. Put your boots on. So it's the contract price that's changing, right? It's not the same as what your regular share amount is going to be.
So when you first start off, you're going to pay what is called the asking price. And you do that for both the stock and options. You pay the asking price, just like you pay the asking price for that house that you want to buy, right? The seller says that, hey, that this is my price and this is what I'm asking for. So AKA the asking price. So you paid $100 per share for the stock, that's the asking price. The bid price will be what you are selling at. So for example, if you now own something, you know, you typically receive multiple bids from people who are trying to buy it from you. See, like I said, the goal is make the investments more human. It's easier to understand.
Do you have an evaluation or monitoring checklist that you follow to stay on top of your option calls and puts?
Yes. I watch, so given in the sense that I'm typically trading my options on a long term, I'm literally just tracking the company. That's how I do it. I literally just track the company because I'm led by performance. So I track based upon how the company is performing. Here's how I ultimately make a decision on a company that I'm going to trade. And here's the other cool part. It's not just companies in which that you can trade on the options market. You can also trade out of ETFs as well.
What's an ETF, Mark?
So an ETF is an exchange. An ETF stands for Exchange Traded Fund. And so an ETF also helps you because of the fact that if you don't want the significant amounts of risk from, say, for example, that singular stock, let's take that same Apple, right? Apple belongs to multiple ETFs, but for anybody that has either watched me on Earn Your Leisure or has, you know, seen me on the Come Up series, you've heard of a ticker called XLK. And that's considered the technology ETF. Apple sits at the top of that ETF alongside Microsoft. So if Apple's having a bad day, but Microsoft is having a good day, then they offset each other. So which means that my losses become substantially decrease because there's a large amount of companies that sit inside this one position. Versus if I'm trading out of one stock, I'm feeling all the pain and the success in just this one stock. So if Apple's having a bad day, you have a headache. But in an ETF market, if Apple has a bad day, it's like a pinch, but yet at the same token, if the other companies are doing well, then you're okay. You could still be profitable, even though that some of the other companies inside that ETF aren't doing well. You just have to make sure that you know the companies that are inside them and that ultimately that you judge them well.
Wise words. Something that we've been hearing a lot in the news, especially the last 2 weeks, folks have been talking about stock splits, which will probably lead us into our next question from Tiff. But can you explain what happens when a stock splits? What does it mean, if anything? I
thought I was able to escape. I thought it was over. I thought it was officially over.
It'll never be over.
Nope.
Shout outs to our friend here that's also driving in a Tesla, because I'm going to use Tesla as the example. By the way, Tesla fam, I see you. So let's take Tesla for example, or let's take both Apple and Tesla. When their stock split, the value stays the same. A lot of folks think that the value increases. It doesn't. The value stays the same. It's just divided by the amount of shares that it's going to become. So it splits. So let's say that you have a stock that's, let's say, $400 and the stock splits by 4. You take the 400 divided by 4, and then that means that each share now is $100. But now you have 4 shares instead of just 1. Now, you won't see the significant value of that until the stock continuously climbs higher and higher and higher. But a lot of folks, they wanted to jump into stock because they were like, oh, well, I'm going to have this and everything else. But that didn't really quite mean anything outside of, say, for example, you just have more share count, but yet they're at the same value as if you had 1 share.
Great explanation. So we know last week Apple and Tesla split. Tiff, did you have a question about Apple and Tesla?
Yeah, a lot of us are pissed because
We gotta stay up for the long haul.
drink
your water.
Y'all get your water. Stay hydrated. So a lot of us
Continue.
and then it just went down. Like, so yeah, it's like, I don't know. Give us a rundown on the whole Tesla Apple, because I think raise your hands if any of you guys actually...
If I may, I'd like to just say something really quick. So I purchased Apple when it did the 7 split. My name is Lola, everybody. Hi. And I invested $4,500. And then it went to 28,000
Okay.
before the second split. So when it came with the second split, my shares doubled. So I went from 50 shares to 200 shares.
Correct.
And so my money stayed the same. I didn't lose money, but I averaged out to about 30,000 at that point. But of course,
Correct.
it's down again. It took 6 years to get to that point.
Yep.
So I mean, you definitely have to be ready to wait the time.
Yep.
So those 200 shares 6 years from now, if it gets back to where it was before this split, I'll have $100,000.
Well done.
Yeah, that's it. I just wanted to throw that out. So
Thanks, Lola.
a real example.
Thanks, Lola.
Thank you, Lola.
We appreciate that.
Right.
And I think you actually gave a pretty good explanation of how that works. We were kind of playing devil's advocate for folks, but that worked out.
You have additional feedback on that though, Mark?
On the whole Apple, Tesla, because a lot of us are all invested in it. And
So I will say this. I mean, if you're already invested in Apple or Tesla, they're phenomenal companies. I think that if anybody's interested in holding Tesla, then I strongly urge for you to go check out a person by the name of Kathy Wood. She's phenomenal. She runs a fund called ARK Invest, or the ARK funds. So, and that's an ETF that also carries Tesla. And on top of that, some of their ETFs also have Apple in them. But she's dope because of the fact that she just makes it super duper plain for a lot of folks out there. And understanding, like, if you're looking at Tesla, and hopefully you just didn't buy into it just for the hype. You bought into it because of the fact that you understand where this company's going. Now, what Wall Street is battling with is there's 3 ways in how you look at Tesla. Either you're going to look at Tesla as an energy company, you're going to look at Tesla as an automobile company, or you're going to look at it as a technology company. Now, if you're looking at it as an energy company, I'm going to just need you to have several seats and sit down. That's just a no-go. Now, if you're looking at it as an automobile company, that's fair because a lot of Tesla's patents are open source. Now, they did that smart because of the fact that they said, hey, we'll do this so that way that the car can further its mission and any other auto manufacturer can jump in the game and be a part of the electrical revolution, which they're trying to give a huge smackdown to gas cars. All right, great. Now, here's how it works for anybody that works in the tech space. You'll understand this as soon as I say it. Most patents come closed. So which means they're closed patents, which means in order for you to utilize the patents, you have to pay what is called a licensing fee or a royalty. Now, given in the sense that Tesla did it the opposite way, that means that essentially, hey, these are open to the public, but then when they expire, now you're going to have to pay the fee. They did that smart because they're thinking about the long-term gain. So when they realize that they hit a certain critical mass number of Tesla automobiles and everything else out there on the road, now they can start getting paid by other manufacturers or other car manufacturers that want to utilize their their framework, like for example, a la their battery technology. Now, if you're looking at Tesla as, say, for example, a tech company, then you're looking at it purely for what it's doing in autonomous self-driving. And for anybody that understands what full self-driving or what autonomous driving is going to do, Tesla is further ahead than most other companies. I mean, you have Google, which is doing its Waymo project, but they can't even get out of Arizona. I mean, Tesla has its autopilot in every single vehicle that's enabled for a person who pays for it. And then essentially that money is sitting there in escrow until, say, for example, full self-driving becomes the standard and it's fully capable. Then Tesla can reap the benefits of all that money that's been sitting there in escrow, and now that becomes revenue/profit. But also at the same token, imagine what that looks like when, say, for example, now you want to come up with a taxi service. Imagine what that looks like when you want to also use licensing that technology out to other manufacturers, or say, for example, public transportation. So that's why I said, when you look at Tesla, you got to look at it from which eyes engage. The reason why I tell people who are focused on the energy side to sit down, because their energy play hasn't even sustained itself yet. What they want to be is a utility company. And for anybody that knows what's happening with Tesla in Virginia, they're now actually doing the install, and on top of that, installing the solar as well as the power walls. And then you just pay Tesla, I think it's about $100 a month, and they're your utility company. These are all the things that are happening. Like, for example, a lot of folks don't know that in Hawaii, Tesla is actually powering a lot of cities in Hawaii where they turn their price per kilowatt hour from 43 cents to 11 cents per kilowatt hour. Hawaii used to be expensive for energy. Now it's not. And Tesla is at the forefront. When we look at a company like Apple, you have to take into consideration, anybody that knows Apple knows that 44% of Apple's revenue comes from its phones. It's its best-selling product above anything else. But at the same token, they figured out a way to monetize after you've purchased the iPhone, and that's what separates them from Samsung. Samsung, you're going to just buy the phone and then you're done. You just go through Google or whatever other services. With Apple, you're going to buy the phone and most likely you'll be paying for iCloud, Apple Music, and other resources through Apple. So they figured out a way to say, okay, hey, we're going to continuously monetize on a phone. Even that's why they don't care if you don't upgrade, because they're still making money. If you think about it, let's put it into perspective. Let's say that you're paying $10 a month, right, for an Apple service. Apple just got you for $120 for the year. Now think about if you haven't upgraded, though, that you bought that phone for, let's say, $500, and then every year they're hitting you for $120, and you stayed with that same phone for 5 years. Multiply that 120 times 5.
Right.
That's smart.
Are we unmuted?
Yeah.
I just have a quick question. Like, what's the amount of stocks that we should be buying in a company? Like,
If it's a good company, you load the boat, as a good friend of mine says. If it's a good company, you load the boat. You can buy as much as you want. If it's there are some terrible companies out there. If they're a terrible company, you just don't touch.
but like, ideally, is it like 100 stocks? I mean, just to be like,
You buy whatever it is that you can. And it's like the smartest move that you can make, especially if you're trying to get out of the game, is what we call dollar cost averaging. So pretty much every month you keep putting money into, say, for example, your brokerage account or your IRA, and keep buying stock. Over a period of time, you've just dollar cost average, and then you just let the stock continuously grow. What I also try to teach people is the 70-30 rule, where when you take this, if you want to really talk about wealth here, and I think I talked about this in one of the most recent episodes of the Come Up series, where it's like 100% of what you make, 70% of that you put it towards investing. You dedicate that towards, say, for example, if it's stock, you dedicate that for about, I'd say about 10 years. If you do it for, say, for example, the options market is 3 years. You do that, you literally have an opportunity to walk away.
Good information. Can you explain how someone can make money when the stock market is going down?
Well, just like you're making a call for the price to go up, there is called also a put when you're saying that the price is going to go down. So for anybody that has been, if you've been watching me before, you understand that I've said that it's smart to play puts against your own positions. So I hedge against myself at least 3 times a year. And those 3 times a year, I'm betting against my own positions in which that I put for. So though that my 2-year positions, they're going to continuously keep running, I don't really have to worry about them. In the interim, I keep some capital on the side. So that way, essentially, when I realize that the market is getting ready to take a turn, I'm setting myself up so that way I'm protecting myself from any downside while also profiting on the downside. So when you're playing a put, you're saying that it's in reverse from your call, where you say that the price goes up to a certain price. When you play a put, you're saying that the price is going to go down to a certain price. And as the price keeps dropping, then so too does the value of the put start to increase.
Thank you. Thank you. Thank you. We're nearing the end. I'm gonna ask this last question that I see in the chat about diversity of the portfolio.
Wow.
How would you?
Is it? I mean, I was just having fun.
What'd you say?
I was saying this is it. I was just having fun. I thought we were just.
Oh, we can definitely keep going.
You can stay as long as
You
you
can
like.
definitely
We
stay
ain't putting you out.
If you have the time, folks, if you raise your hand, we're gonna actually just let you take over and jump in, and Camilla will unmute you once the hand is raised, and you guys can ask your own questions at this point. But do you want to talk in the interim about diversifying the portfolio, and then while people are raising their hands, we'll jump to them next?
Sure. I mean, so you want to keep your portfolio diversified, but I always say this, don't be too diversified where it's like you become like the road team, where you're always on the road and it gets tiring. Be more like the home team where you have like a select amount. I always say just more like 5 companies or 5 different positions, and start there. Because when you're spread too thin, spread money doesn't really make very much money. And think about it like a war. When you spread your army too thin, most likely you're going to lose. But when you have your army more focused, then ultimately you stand a better chance at winning.
That's great advice. That's real.
That was really real. Do we have any questions? I'm watching the chat. Camilla's shaking her head no. So we're gonna go back. You talked a little bit about dollar cost averaging. I have a question in the chat that says, do you suggest dollar cost averaging or shorting or both? And how do you determine when's a good time for either?
So when I'm shorting a company or when I'm shorting a position, I'm shorting it based upon, say, for example, like a Kodak.
And can you explain what that is for folks who may not understand?
Well, in my world, shorting is where I'm betting against the stock, and I'm betting heavily against it for the stock to go down because I feel like the stock is run too high off of speculation. And I believe that the stock is going to go down. So I definitely want to make money on the downside. So I'm willing to bet against that company, against the fact that it could just run up and keep going and I lose whatever it is that I invested. But for the most part, I'm shorting the stock to say that the stock is going to drop. And so for a company like Kodak, I think many of you have probably seen it in the news a little while back, where a film company was going into, say, for example, pharmaceutical or health. A company that hasn't been relevant since 1999 was going into health. That was an easy short for me. I started betting against the stock because it ran up so high on exuberance, and I ran up to about 60% return, and then I got out.
Smart.
Wow.
Okay, I see you sipping that water. Go for it. Yes.
There's so many questions in this chat. I'm trying to vet them at the same time. I'm going to ask these folks for questions in the interim. Anybody have anything that they want to ask right now while I'm sorting through these?
So I have a question because I'm still very new in this space, right? So when you mention the starting 5, right?
Yep.
We talk about like your 5 kind of base companies because you want to know these companies intimately. I heard you talking about report cards. You're looking at how well they're performing. You're really doing your homework. And I think for a lot of us that are new in this space, we want to go the easy route of hopping onto a Robinhood, asking other people for advice, not really doing the homework. But once we start really investing our time and energy into it, what kind of 5 companies or industries do you really advise us to look into for investing?
You want to see some magic real quick?
Yeah, let me see that magic.
Okay, let's play. Everybody wants to see some magic? All right, let's play.
Want to come up.
What's the magic?
Check this out. Here's a secret. Pick winners. Pick winners. Like I was gonna say, like, what are the 5 companies that you know of?
Apple, Google, Microsoft, all companies that's in the Bay Area.
Right.
What area are each and every single one of these companies sitting in?
Tech.
What sector is going to be the sector that will carry us into the next century?
Tech. You're absolutely right. Wow. And you really see that.
See that?
I'm just,
Magic.
you was drinking water, I was drinking Jameson, so I'm just vibing. I'm just switching up.
Do your thing. Do your thing.
But
Yo,
no,
if it gets too tough, I may have to switch over to some Izzy. So.
We got that too.
we got those on deck. But really, I mean, so obviously the world is shifting, and tech was always the move, but now we have COVID, like we have global pandemic, we have all kinds of stuff happening. So,
But tech like really started to flex its muscle because the world significantly needed it.
exactly.
And honestly, tech was ready. I mean, you guys have to look at it like this. Why do you think that the US and China are beefing with each other so hard?
Come on, let's get into it, Mark. This is what we was waiting on.
Oh, well, you know, it's like if you want the real, you know, just you know, anybody that knows me, I'm going to give it to you straight, no chaser. So think about it. Like, what is China known for?
Copying.
Okay, outside of that.
Production, manufacturing,
But what is it that they manufacture?
goods.
But what's the number one thing that's holding all markets afloat right now?
Microchips and tech, yeah.
Okay, EJ.
The world of AI is now that, like, we're not even, like, think about it like this. World War I and World War II, they had every single one of them started because of a specific reason, right? We're technically in a World War III. It's just a lot of folks just don't know it yet. The problem is just that it's not anything that's gonna, well, we don't expect people to lose their lives over it.
Right.
What we expect is for one country to come out as the global leader and the other one will be the follower. Now, think about it. You just said that you guys live in a city where most of your innovative minds and innovative companies reside, right? Those same companies are the ones that make America competitive to the rest of the world. It's no longer the military anymore. And if you really think about it, it's like when we think about drone technology, like everywhere you look, every sector that you look, like think about it. When you think about real estate company, what real estate company do you know of?
Right.
What is it? I can't hear you.
Zillow.
Isn't Zillow a tech company?
Yeah. Wow.
Interesting.
Everywhere you look, you're starting to see tech literally do this. It's weaving itself into the fabric of everything. And here's the thing, when tech has weaved itself in, it doesn't let go.
Yeah.
That's literally the fundamentals of tech. Once it started to infiltrate into a specific space or into a specific sector, it doesn't let go. And then the world becomes reliant on it. Huh?
I'm telling people, you hear that? Invest in tech.
Okay. With that being said, we do have some hands up. So I'm going to ask Camilla to kick it over to, looks like we have some folks. Go ahead.
Go for it.
Go ahead, Camila. Sounds good.
Please say your
Alvina,
name.
I am unmuting you. There we go.
All right.
Hi.
Looks like
So I just have if you could shed some light on some pharmaceutical companies that you think may be good investments.
I like Seattle Genetics. I like Pfizer to a certain degree. I think you're starting to see Moderna creep into the forefront. If you want to go even further, I would look at, say, for example, the XBI ETF, because anything that you see in the top 15, they're solid of that ETF. Wait, where'd you go? Oh, there you are.
Great question.
Great question.
And nice moonroof too. Shit popping.
And she's on mute again, Camilla. It looks like she's trying.
Let's see. Sorry about that, folks.
It's okay. In the interim, I'm gonna move on to a question that I got via text.
Oh, she's unmuted.
Well, she's back. She's back.
Okay, and so my second question is, I am new to, thankful for my sister who kind of gave me a little game about it. The other question I have is if you can explain a little bit about index investments and if you think that that's a good thing to do if you're a
It's one
beginner.
of the smartest moves that you can ever make, because when you look at
Okay.
indexes tell you, and when you're looking at index sectors, here's a cheat code for everybody. When you're looking at indexes, they give you a good read of where the market's going. Where is it that people are putting their dollars? So, for example, hence the reason why when we look at the technology sector or tech index, the tech index represents 26% of the entire S&P 500, right? But yet it's moved 100% of the S&P 500.
Wow.
So we're at record highs thanks to 26% of the movers and shakers of that entire sector. Like, let that sink in for a second. Like, the Dow is close to record highs, the NASDAQ is just popping. The S&P 500, which is the real read, is telling you that tech is literally taking shape and form and fashion and telling you that it is the leader. And there's tons of index funds out there in which that you can invest in. A lot of folks also want to look at, say, for example, where is it they can find the best steady performance. Index funds will be it. And then on top of that, if you're looking at outperforming the market, typically index funds outperform the market as well.
Thank you so much for answering that. Thank you, Melvina, for actually asking that question as well. We're going to go to Marcus Edmonds, who has a question. I'm trying to unmute. Marcus, if you can unmute yourself. There we go.
Okay.
Marcus. Hey, Mark.
How you doing? I missed the beginning, so I don't know if I missed this part. I don't know how you feel about Robinhood investing, and like, how do you feel about, is that a balloon? Is that a balloon? Yeah. And all the like fractional investing, is that balloon market that's like gonna like be an issue, or is that something that's
No, I mean, there's nothing wrong with fractional shares. I mean, if you want to buy fractions of, say, for example, stock, there's nothing wrong with that because you own a percentage of it. Me personally, I'm not a fan of Robinhood since I don't like it. Like I said, I don't like its practices and how is it that they make you guys pay the overprice. Mm-hmm. So, which means that you're 9 times out of 10 overspending for something in which that, you know, the person at a typical brokerage, they're spending a lot less for. So something in which that they market as free and easy is becoming very costly in the process.
But they got you in there now.
If I was you, run away. What did he say? What did Scar say in Lion King? Run away, Simba, and never return. Like, good question though.
Thanks, Marcus, for that question. We appreciate that. I got a question via text. And I'm going to put some pressure on one of my childhood friends, Karima Arnold, to raise her hand because I heard she has a question. Someone texted me this, and we were talking a little bit about China and politics earlier. What are the implications of a Trump reelection versus a Biden reelection? And what happens to the stock market in something like that?
Yeah, because your boy, the master investor guy, he's always talking about this stuff. Earn your leisure. About how the stock market really dictates.
Everybody's been asking me about what is it that nobody has really asked me, and I kind of like felt good that nobody's asked me, like, you know,
welcome to the Bay.
Political landscape can play out, but I always have a rule. You ask me a question, I'll give you an answer. So here's how I see it. Joe Biden's a moderate Democrat. I think Wall Street is already priced in the fact of having a Biden presidency, and I don't think that people are as afraid of Biden and Kamala Harris as the newly elected. I think that under a Trump presidency over another term would, say, for example, put a Band-Aid on a lot of things, and of course you'll see the market become a little bit even more inflated due to, you know, a lot of the deregulation that he brought for the table. When he got elected, the market significantly spiked because of the fact of what he stood for, which was deregulation of a lot of the financial, you know, pretty much he stood for a lot of deregulation when it came to a lot of financial, like, say, for example, incentives, like, for example, taxes for corporations. I think, in my opinion, I think that Biden and Kamala Harris will win. I think that Trump will try to challenge those results, but I think that where a lot of folks are paying more attention towards the presidency, they're forgetting to focus on the real election that really matters, which is Congress. So the Democrats already have the House. If the Democrats take the Senate as well as maintain the House, then it doesn't matter if, say, for example, Donald Trump gets reelected, because now you have significant checks and balances. And then on top of that, it brings a little bit more stability to the market. Now, at the same token, when you talk about it from the stock standpoint, it depends upon who gets elected. Now, if we're electing mostly moderate to some progressives in there, then you will see some shakeups, and you're already starting to see that folks are starting to eye tech companies as potential monopolies under a Democratic House and Senate. You will probably see that a little bit more further scrutinized, but I think in the end, it's not going to really hold water, because as long as these companies are not being predatory towards the consumer, and as long as the consumer benefits, then they don't have really anything to worry about yet, unless new rules are written. I think that when we're looking at if Joe Biden is elected, you have to look at the type of sectors that will definitely be beneficial. Like, for example, you'll probably see industrial sectors start to rise up a bit. You may even see, well, I don't think you'll see financials rise, because financials have sucked for quite some time. And honestly, nobody really likes financials. They don't really perform as much as everything else does. I think that, in my opinion, I think that the market will just remain the same. Now, when we talk about U.S. and China trade, I think that the reason why you're not seeing any new developments on U.S. and China trade, because I think China knows something that the rest of the world is starting to come to shape, form, and fashion, and understanding along with the American public, and understanding that it's not going to be Donald Trump, the next president, or remaining as president of the United States. And I think China knows that. And I think that that's the reason why they're sitting back and saying, okay, hey, we can hold and wait for the next president to step into office, and then let's formulate a deal.
Nice. Karima, I'm unmuting you right now.
Hello, everyone. So I had a question. Do you have any recommendations for stock under like $100, under $50 that are affordable for people? Because I looked on your page and you have a lot listed, but they're like $500 a share, $100 a share. Some of them are a lot more expensive.
Let's take a look, shall we? I like XLC, which is definitely under $100, and that gives you Facebook, and that gives you Netflix, that gives you Google twice. That one's currently trading at $60.88 a share. I like XLI, that's the industrial sector, which gives you Boeing, Caterpillar, Raytheon, Northrop Grumman. That also is at $77 a share. Let's see. I like ARC, which is the innovation ETF that also gives you Tesla, Square, and many other great companies like Roku. That one's currently trading at $86 a share. So there's some pretty dope, and most of those are ETFs, because ETFs will always be cheaper than the actual stock themselves. So yeah, there's tons of good opportunities out there in which that are less than $100. Now, under 50, that's a challenge. That's
great question. We thank you for asking that, Karima.
No problem.
Next question comes from Miss Lynn-Teese Jones. I think. Trying to unmute.
All right. Hey, y'all. Thank you so much for doing this, Mark. Shout out to Black Wallstreet. Appreciate y'all. So I have two questions. First one is,
I'm just kidding.
y'all hear me? What are blue chip stocks is my first question. And the second one is, what is the minimum amount of time I should plan to let my money sit in an investment account? And as a quick backstory, I invested a good amount in Whiting Petroleum because I got in at a good price, and it historically was at a high, and then it bubbled to like 70%. And then I saw it declining, and I was like, well, I should wait it out. And then it did a reverse stock split, and it's just money went all over the place. It's not where it was.
Okay.
So what's the amount of time? What should I look for? And then blue chip stocks. And then I have my 11-year-old entrepreneur who wants to ask you a question after. Wait.
So blue chip stocks.
He's ready. I'm like, I need my question answer first.
So blue chip stocks would be like, say, for example, McDonald's. Let's see, you have Facebook, Johnson & Johnson, Berkshire Hathaway, Berkshire B or Berkshire A. Those would be considered like, say, for example, your blue chip stocks. They can, and pretty much when you think about blue chip stocks, they can typically withstand any type of market conditions and still be able to thrive within them. So that's typically how we define a blue chip stock. The second question, because I kind of got like too excited because there's an 11-year-old investor that's going to ask us a question.
Yes. And he ran somewhere. He probably wants to go get his gold chain. I keep telling him it's bad investment, son, and these gold chains. So he's sitting there with me. Come back, Jeremy.
Wait, what's the second question?
The second question is, what's the minimum amount of time I should plan to let my money sit in an account?
5 years.
5 years. Okay. Been down. Ask your question. Okay, 5 years. And now he wants to say something.
Where's the gold chain?
I give him enough time.
It's everywhere right now. No. I was here with me, my mom, and my dad. I just want to really thank you guys for actually being here and starting this Zoom call, because if I hadn't been sitting right here, I wouldn't have known half of the things I know now. So thank you.
Oh, sweet baby.
That's the future right there.
Yeah.
That
He
was
left
the
now.
second question I could have gotten.
Thank you.
All right. I got a couple questions that came through on the chat, and a multiple of something that came through here. What are your feelings on investing in marijuana stocks?
Good question.
Good question. I got some marijuana stocks, me personally.
Yeah, how are they doing?
Drink water. You drank water, y'all.
Drink your water, hydrate.
How are those marijuana stocks doing? Exactly. I mean, you're going to be pretty much, a lot of folks are investing in marijuana stocks on the premise that they're hoping, and for anybody that's seen my video on hope, leave hope at the door. They're hoping that it crosses federal guidelines where you can cross over state in countries like, for example, Canada and the United States, where you can move marijuana from place to place. The question is that you also have to take into consideration the taxes that many of these marijuana businesses or the industry takes in from the state level. I think that it's a profitable business, but is it something that they can consistently improve the margins on? I'm starting to look at marijuana companies as the next generation of agricultural, and no shade, but we've seen how the agricultural market has done. I think that we're all family here. So I think that the marijuana businesses that are doing a lot better than the ones that you see that, say, for example, are publicly traded are the ones that actually don't have a business license attached to them.
Great information. What is good due diligence to look for before I buy a stock?
Look at the earnings. In the earnings, they tell you exactly what they did, and then they also give you the guidance, which lets you know how they foresee things coming down the pipeline, aka the future. Look at analyst research reports, because those should coincide, and they pretty much have most of the time, smart people that go through and do their due diligence and do their research on the company as well as the stock to give you an idea of what they believe is price target. Pretty soon when you start compiling, I always say for every earnings report that you read on a company, you probably look for 5 analyst research reports that are very objective. And so the reason why you do that is because you get a narrative for the low case, you get a narrative for the high case, and everything in between. The next thing that you do is you look at the stock to see how it's performed, to see if there's actual interested buyers that are there. And then the final thing that you look at is you look at the news. Each one of these things represents a small piece of the pie. And for anybody that has an Apple iPhone, or an Apple iPad device, you got the best of both worlds, because you have one of the greatest tools that sits on your iPhone or iPad that many of you never even knew existed, called Apple News, and it's free. All you have to do is just put in the name of the company, and literally it scours the internet looking for articles. And sometimes it also pulls research as well as financial news about the stock. That's just the first part. Second part to that is using your brokerage, because most brokerages outside of, unfortunately, Robinhood and the other ones, they give you analyst research reports. So they tell you what the analysts are, what they're saying, what they're thinking, and you can pull the full report. Typically, all you have to do is read the first few pages, and then you're good to go. I know that on E-Trade, it also goes even further to tell you exactly what's the percentage of times that analyst was right versus, how many times have they been wrong. And then on top of that, when you talk about the earnings reports for any company that you're looking at, every company that's publicly traded has what is called an investor relations site on their actual website. All you have to do is just type in investor relations and then add the company. You can type that in on Google and it'll pull the link for you. Final thing which you can look at, which is a resource, is using bar chart, because it kind of ties a lot of that stuff in there. If I had the opportunity to share my screen, I'd be able to show you. But yeah, that's a pretty dope platform where, again, a vast portion of its resources are free, but it kind of like puts everything together for you to give you the fundamental knowledge, as well as giving you a snapshot of what analysts are saying.
All right, I want to definitely, I want to go. We're getting questions from everywhere now. I have a question from Dominique C. I'm going to unmute you. And Dominique, the floor is yours.
Hey, can you hear me?
Yes,
Yep,
we can.
hear you.
Oh, perfect. Hi, Mark. So I've been, I just got introduced to you probably about 2 weeks ago. I've also sent you a DM. We've chatted. So thank you so very much for everything that you're doing. To you, and
Yes.
I had a question. I am new to the Bay Area. So hi, guys. I'm coming from the East Coast. I had a question. I know that you've given like some really good gems around like your call strategy, the rolling fours. But I've been like, so for me, I have to be organized, right? So I put together this thing that I'm going to do every single day so that I don't miss it, right? So I was like, I asked about the checklist, and pretty much you've already given that in your last answer around the earnings reports and blah, blah, blah. But I want to know more about like your put strategy, because I'm thinking, well, if come next Monday, we choose our specific ETFs and we invest however much we're going to invest for the long call, that 2-year long call. What does your put strategy look like with respect to that, right? Like you say you do 3 times a year.
Yep.
So I kind of need to figure that thing out. So I'm writing it out and I know what it looks like, right?
I'll give you the cheat code of when is it that I actually do it. So I'll actually let you know the timelines of when I do it.
Oh, perfect. That's what I wanted.
So typically when I'm doing my put strategy, and for anybody who knows that when I'm playing my long-term 2-year positions, I'm hedging against myself every year, at least 3 times a year. Now, the number one time that I typically do it for is I'll start around July, because that's where we reach peak point in the market. And then August and September are typically garbage months. And the reason why we say that they're garbage months, ask yourself this: when is the typical time when people are on vacation? People like to take breaks. And when they go on break, that's exactly what they do. They break. So essentially, you're going to see them gone from the stock market. So that's another thing that I look at is also I look at the volume. I look at the volume and start to notice that when the volume is dropping, especially during specific times of the year. So for example, I said August and September. Mm-hmm. I also sometimes will put out a put, especially during election years. I'll put out a put sometime around October just to cover myself for November / really for November, but I play it till December. Also, I'll put out a put around February, late February. And these are just simple like puts, and I typically have a 1-to-5 ratio. So that means for every 5 contracts that I own, I'm playing 1 put contract.
Okay.
So nothing really big, nothing really major. I'm not looking to make that equal the same amount of call contracts because then that becomes expensive. It's just there just to protect me from any intermediate downside risk that I can say, okay, hey, let me profit off of this. Take this money, flip that, rinse and repeat, go into something else.
Okay. Thank you.
No problem. Good question.
All right, so I'm gonna go. I want to show the folks that are watching on Facebook a little bit of love, and that's gonna be our final question of the day. We're gonna wrap it up after this next question. This is a question from Facebook. I see a lot more people of color investing in the hospitality industry. Do you think this will continue to be a good market on the West Coast? Get your water ready.
Get your water. Get your water.
Next case. Let's try another
Hold
question.
on, I'm in the hospitality industry.
Hey, no shade, but I'm just saying, like, yo, like I said, I'm gonna give it to you straight, no chaser. Ask me this: do you think that hospitality is worth investing in?
Not right now.
When has hospitality ever matched what the tech sector can do, or what the industrial sector can do, what the material sector can do, or what consumer discretionary can do? Can hospitality even match? I'm going to lower the bar. Can hospitality even match the retail sector? That's why I said next case. We should probably pick a different question.
All right. I'm going to go to Gwen's question because she's been punching me in the back over here.
She asked about Neo.
She wants to know about Neo. She wants to know about Neo. And for those who don't know what Neo is, maybe you could explain it really quick.
Neo is an electric car company that's based out of China. They're doing some pretty dope things. I don't think that they're doing anything. And so let me put on my venture capital hat, because this is what allows everybody to kind of like see how I see the world or how I see markets. I'm asking you, I'm asking, like, when I'm looking at an investment, I'm asking, what is it that you do special that nobody else can do? What is it that you're doing? Is it patentable? Is it something that somebody's willing to buy? Is it something that's ultimately scalable? Is it something that ultimately that you have something that brings that extra something that the other competition can't bring? I mean, think about it. Neo is a great, like I said, it's a great car company based out of China. And I think that they can do well in China. But the problem is China also allowed another major player to step into your own backyard, AKA Tesla. Here's another problem. Tesla has what is called a supercharging network, AKA their own gas stations in which that they can collect revenue off of. Neo doesn't have that. No car manufacturer has that. And a lot of folks downplay that. But yet Tesla makes money off of that. For all my Tesla drivers out there, you understand what I'm talking about. And it's growing. Then on top of that, you have to ask yourself, is there anything in which that Neo can give over to another company that they can't go out there and produce itself? The answer is no. You have a lot of great companies that can throw billions of dollars. I mean, hell, you had GM throw, what is it? A significant amount of portion. I think they bought 5 to 11% worth of Nikola. I mean, but I will say this though, so that way I can put this on everybody's mindset. A company that everybody should be paying attention to is called Rivian.
Can you type that in the chat?
Sure. So Rivian, it says you cannot chat with SF Black. Oh.
Okay. Just tell us how to spell it. Tell us how to spell it. And
Rivian. I'm hurt.
We're a little exclusive like that. You have to forgive us. No, we're kidding.
It's all good. It's all good.
So I'm gonna put the jewel emoji behind that, but I'm on the computer, so I can't do it. But
so they're a private company right now. They haven't released any vehicles yet, but what they have shown versus what anybody else has shown, they actually shown a vehicle that actually works. And they've actually shown that, okay, hey, that they've got some muscle behind it. Typically, another way that you can judge a good company is look at the investors that stand behind it. I'm sorry, has GM done anything significantly special over the past 10 years that anybody else can pull up? Yeah, I see somebody sipping wine. That's exactly what I would be doing on that answer too. All right, so if we look at it though, look at the investors that now back Rivian though. You have Jeff Bezos, who has dumped, Amazon themselves have dumped 500, I think million, or I think it's $5 billion behind Rivian. And then Jeff Bezos said, allow me to reintroduce myself and I'll come in and match that. You have other players like, for example, Ford, which are working with Rivian, which Ford is technically Ford is a better company than GM. But if you look at Ford, say, for example, within the truck space, there's no other truck out there that outperforms the Ford F-150. It's the #1 selling pickup truck. And now you have Rivian in the space, and Ford is working with Rivian so that way they can take the skeleton of their system. That's game changing right there.
Yeah, it is.
That is super duper game changing versus, say, for example, what the other players are doing. Now, I'm not saying that NIO won't do well, but compared to the other players in the space, I'm sorry, I can't give NIO that satisfaction to say that it's on the same level as Tesla. And that's really where you really have to look at it. Like, for example, whenever you saw a phone that came out, what was it always compared to?
iPhone.
Oh, man.
Before we close out, I just got a quick question. Like, what investing when the market is closed? Like, do you suggest that, or should we wait till it's open? Or
If you're investing for the long term, then it doesn't really matter. I mean, here's the thing: to a lot of folks, like and we as a people, we get so caught up into it and what we're investing today versus what it will be. Like a wise person once said in a quote, he said, "I tell you how it is, you tell me how it might be." So when we think about it in perspective, don't get caught up in the today's. Don't let the moment get you caught up versus where the journey is taking you. A lot of folks get caught up into the moment and then they let the moment literally jack them up or stop them from ever reaching greatness. The moment, it's going to happen regardless. The question is, can you stomach the moment and say, okay, hey, I'm going to pay this? Like, for example, I'll give you one of the trades in which I just recently executed. I actually executed a Tesla trade for September 16, 2022 at, I think, $90 a contract. So that's $9,000 a contract that I just paid. Now, if I was so caught up, I would say, okay, hey, I'm going to just buy these contracts at $9,000 and this is too expensive for my blood and I'm going to walk away. Problem is, I've been down this road before. I bought Tesla at $85 a contract, which was really $8,500 a contract. And then when Tesla had its run up, I ended up selling it for $546 a contract. Yeah. Remember what I just told you all about how that math works. This is the new math. So I could have easily got caught up into the moment and said, you know what, this is a little bit too rich for my blood and everything else. But I understand the trajectory of where the company is going. So I was willing to make that investment in that trade. And I did well. I expect the same result, hence the reason why I'm rinsing and repeating.
All right. So we still have a bunch of questions coming in.
yeah, they want to know about Bitcoin before we get you off. Anything about Bitcoin?
Bitcoin has become nothing but an asset class. I mean, it's pretty much used as a hedging tool. I think that until Bitcoin is able to get past the $14,000 marker, it's going to be pretty much stuck in purgatory. That's a huge breakout number for Bitcoin. If Bitcoin can break out, and like I say, if we're a fifth, we'd all be drunk. But if Bitcoin can break 14,000, you can easily see this asset jumping up to about 20,000, 22.
Amazing. So,
but it's also predicated based upon also how the market is reflecting as well. People are running to, say, for example, such asset classes because of the fact that they can't get yield in, say, for example, bond markets, and as well as a weak dollar, they go other places. Like, think about it. When you see gold rise, look at the dollar. Gold rises when the dollar drops.
Amazing. So since we have so many follow-up questions and not enough time, we're hoping we can set up a part 2 at some time. I think before we get out of here, just let the folks know where they can find you one more time. I'm sure they'll be in your DM sending you some good questions.
Just remember to do your research if you hit me in my DMs. If I notice that you haven't done your research and your questions, then ultimately you'll see that I've seen it, and that's it. But you can find me on Instagram at IAmMarkMonroe. You can also find me on LinkedIn. Just look up Mark Monroe. I typically don't really hang out that much on Facebook, so Twitter, every now and then you'll see me spark a conversation. You know, if I spot it, then I'll check it out. But for the most part, I'm on Instagram and LinkedIn. You can also check us out on the Come Up series. You can find that on YouTube. Pretty much for those in whom when you see like the super chats hit, we don't like to collect a dime from anybody, so we're not trying to charge for a course or anything like that. Any money that comes to us, we typically throw that towards a nonprofit. So we don't need, like, literally, I do this from the heart. I don't need anybody's money. I made more than enough of it, and I still make enough of it even while I sleep. So I don't need it. You said what?
They hit you with periods.
Hey, Mark, on behalf of SF Black Wallstreet, this was our first virtual event, and we want to thank you from the bottom of our hearts. Like, TIFF is really inspired all of us in San Francisco and the Black community to really get into and talk publicly about Black wealth and generating Black wealth in San Francisco. So I want to thank my sister right here, because she put it vision that we all came together to execute. But we can't even tell you how much it means to us to hear you say what you just said, that this is from your heart, and the amount of time that you gave us. You know, there's plenty of people out here, like you said, we're in the tech capital. It's billions of dollars surrounding us, and there's nothing for free. But to have someone like you come, you know, from your heart, share your platform, and give all this time to us just means everything. So thank you.
No problem. The game is told, not sold. So.
That part. We're going to use that. Thank you, Mark. We really appreciate it. I follow him. They think I'm the expert. This is the expert.
Just a man. Just a man.
All right, y'all.
All right, y'all.
We thank y'all for tuning in today. Round of applause for these ladies for putting this together one more time. We'll catch you back on the Instagram. Have a good night.
Bye, guys.
Bye, guys. Peace.
Bye.